pre-budget statement for budget 2025. The key messages that the council look at. First of all, the economy is in a pretty strong position. Growth and the level of output is quite high. So we record high employment rates, and recent data on wages shows that wage growth is now outpacing price increases. So that we're seeing real wage increases. However, when this does come at high pressure, particularly on prices that we might consider being domestically set, such as rents, food services, medical costs, very much based on what's happening within the domestic economy. Yes, inflation has very much been driven by international factors, but domestic pressures are emerging, have been in certain sectors for a period of time. And then finally, but not sticking to its own rule, the government is fueling two major risks. So the government has a rule of how much it intends to increase government spending by, but it has been exceeding that and does intend to exceed it again for next year. One are large and growing underlying deficits. So at a headline level, the public finances might appear to be in a sound position, but once you strip away what could potentially be volatile receipts and corporation tax, and consider the position of the economy being in a very strong position, emerge pretty quickly. And then of course, by adding more spending to the economy, we can potentially see even higher prices. So we go through those key messages in a small bit more for the next couple of moments. So first is on the strong economy, and we are seeing pretty rapid growth. So on the left hand side, we have our preferred measure of income, the CSO modified GNI star measure, which does show some volatility linked to COVID in 2020 and 2021. The growth in recent years, 2022, 2023, close to 5%. So the economy growing pretty rapidly and is now at what could be considered above normal levels of activity. If we take where the economy was pre-pandemic, pre-COVID, it was performing well. The dark green line being the performance of the economy. Then we have these COVID sort of now actual is well above the pre-pandemic trend, and it's also significantly above what could be considered the potential of the economy. So we have very high levels of employment, very low levels of unemployment. So the economy is in a strong position with rapid growth, potentially is above its potential level of output. And if you look at just a measure of employment, you take the overall population, particularly those of prime working age between 25 and 54, and we have a good long-term data set from the CSO and other sources right back to the middle of the last century, close to 1960, and we see that the current level with 84% employment rate in that prime age between 25 and 54 is a record high. An issue with record highs is can they be sustained? Take where the economy has been over the last 60, 70 years. We've never seen employment rates as high as they've been in the most recent publications from the CSO. So the starting point is that the economy is performing very well and is in a position of rapid growth with potentially above normal levels of activity and very strong employment. A large part of this has been driven by consumer spending. Again, we see some of these COVID distortions when large parts of the economy were shut down in 2020 and 2021, but we've seen a very rapid recovery. And even with this pretty strong trend that was there pre-COVID, we're now back to that. So with strong growth up to 2020, even with the distortions, we're now back at, and even from many recent quarters, we've been exceeding that. As we said, real wages are beginning to bounce back. So if you compare hourly wages and look at them adjusted for inflation, again, you have strong growth up to the pandemic. And actually during the pandemic, with various compositional changes and also falling prices, real wages grew pretty rapidly during the pandemic. Then we get the correction, but now we see this rapid wage growth in recent times. And again, back to this strong trend we saw pre-COVID. So most of the COVID effects have washed out. We're now back to the pre-pandemic trend. So this is not back to the pre-pandemic level. We're significantly above that. We're back to the pre-pandemic trend of real wages. So we're now seeing wage data from the CSO with nominal wage growth exceeding inflation after having a period where that wasn't the case. Like steep drop here, 2022, early 2023, but inflation was far outpacing wage growth. That has reversed in recent quarters. we're now back at the pre-pandemic trend. And if you look at certain sectors, like construction, accommodation, what we consider low wage or lower pay sectors, you see this is even larger. So again, looking at the trend and the gap between the trend and where we are now, and the gap is even larger. So there's sort of pronounced wage growth ahead of inflation across the economy, reflecting labour market pressures, the unemployment rate being so low and the employment rate being so high. There isn't slack in the economy. There's strong demand for labour, and that's leading to increase in the nominal wage growth. And now when we've lower inflation, that's driving real wage increases. If we look at these domestic price pressures, because of the sort of capacity constraints within the economy, and we're trying to strip out the clearly international effects have had a strong impact on Irish inflation in recent years, particularly energy. But if we strip out energy and look at the sort of a measure of domestic prices, such as the hospitality sector, the supply of medical services, rents for housing, and food services, all which generally wouldn't be internationally traded, but very much based on the pressure in the domestic economy, we can see that inflation here does remain elevated. Yes, it's not as high as it was a number of years ago, but it is at quite an elevated level. And compared to the last 10, 15 years, it's at a level that hasn't really been reached apart from a brief period here in the middle, and remains over 4%. So yes, headline inflation has dropped. A lot of that is driven by energy prices, which of course is impacted by international events rather than domestic events. But look at it domestically, because of the increased spending both by households and increased spending by the government, which will return to, we are seeing these pressures emerging in the economy with domestic prices rising. Looking at nominal wages, again, perhaps for the 2023 figure, some compositional or COVID effects. But looking at the national accounts data, we can see a pretty strong increase in nominal hourly wages for 2023. And data from the CSO for 2024 will likely point possibly to something similar. So again, wage growth beginning to rise and accelerate a bit, and now being exceeding inflation and leading to real wage increases. We mentioned the spending, so consumer and household spending is back on a strong pre-COVID trend, but government spending is also adding to pressures, adding to demand in an economy that's operating above capacity. Record employment rates, very low unemployment. The government being the largest actor in the economy can add to demand with the level of spending it's undertaking. And if you look at what the government has been doing compared to their plans, we said the government has a rule about increasing spending at a particular rate, and that's what the grey represents here, or just that the impact the government doing on the else. The green is the additional spending the government is undertaking. So beyond its stated rule of limiting spending increase to 5% per annum. So this was stated in 2021, and it's exceeded in the last 2 years, is going to exceed it in 2024, and plans to exceed it in 2025. One impact of this additional spending is the government adding to these pressures we're seeing in the economy. Estimates by the central bank say by the end of next year, there'll be an almost 2% cumulative impact on prices as a result of the government going beyond its sort of stated limit of 5%. Is 2% significant? When we take a typical household that might have outgoings of €50,000 a year, well, that 2% equates to €1,000. If the price level is higher, as is estimated to be, because of the additional government spending, so no households might be benefiting from the additional government spending on one side, so they can see a direct benefit from the additional spending the government is doing. There can be indirect costs through a higher general price level. So there can be an illusion of a gain being offset by these indirect costs. Because we're seeing these domestic price pressures rising, in part being contributed by the additional spending by the government, some of the gains that might be arising from additional government spending are being offset by higher prices. So looking at how the government has been exceeding its rules against from 2021, the government said that it was going to have a 5% cap over the medium term for its government spending. This is a rule, so a net of tax increases. It could increase spending by more if it was to increase taxes and have revenue raising measures. So 5% is a net rule. So this is the path that government spending will have followed if the 5% rule had been adhered to. If the government was to adjust for inflation, which there's a certain argument that fiscal policy should respond to, particularly in 2021 and 2022, when the inflation was driven by external factors, the impact on households, the reduction in real household income because of soaring energy prices, which wasn't caused by domestic factors. And if the government was just to stick to following inflation, you have that grey line there, and you can see maybe in the early part of the inflation surge that was the case. We started looking in 2024, particularly given the plans for 2025. You see that the idea of inflation justifying the excess over the 5% rule no longer stands up. Inflation has fallen, and we continue to see spending above the 5% rule. And the difference in the actual to the 5% ask, which the government stated in 2021, is around 12 billion. So if the government had stuck to the 5%, government spending would be 12 billion lower than where it is now. Now we have seen inflation, there still is a pretty significant gap of 4 to 5 billion that could emerge by the end of next year, if the plans the government has presented in the SPU and the summary economic statements are followed through in the budget. And that's just what we've seen. Maybe one of the most significant developments throughout 2024 is what we see over here on the left. And this is just the overruns in the Department of Health. So budget 2024 set last year. We had the estimates, we had the annual profile of spending in the Department of Health and the HSC. And this green line here, again, is the actual, represents the overruns from that profile in the first half of the year. And we've seen overruns in health before, these are not new. So all these grey lines here represent recent years, going back as far as 2024. What's different for up to 2024, 2014 to 2023, what's different for 2024 is just the scale. This green is what we've seen. So spending in health has already exceeded the profile by 1.4 billion. And the government itself has said it envisages an overrun of 1.5 billion for the year. And here's where we are, just to the end of July. You see this green line suddenly flattening out and going this. Based on previous years, it's possible that it's even more. So this is just a projection, but we can see what direction we've seen up to now. And if it continues at the current pace, the overruns, so this is beyond the planned increases in spending and health, could be up to 2.5 billion. So just in one department. So this is not the increase, this is relative to what was planned in the budget presented this time last year. So you can assess a budget, but if during the year you go off course with a significant amount, the budget is not being adhered to. And again, this additional spending, the additional employment, is all adding to the pressures within the economy. Increase in health staffing, increase in spending, a lot of it very much domestic or very much service driven, is adding to the capacity constraints in the economy. So spending on health, the council has no issue with that. Issue is on the planning, and does the economy have the capacity to absorb it? So clearly from a planning perspective, the figures presented in last year's budget aren't being adhered to, and then as you pump this money into the economy, and it has wider implications on prices, then the consequences are being felt elsewhere. And not only on the health side is last year's plan subject to revision. One thing that's happened frequently over the last number of years is the allocation and spending of a Christmas bonus for social welfare recipients. Again, nothing that the Fiscal Council is opposed to, but it's just that it's not in the figures at the start of the year. You know, every year as we get closer to Christmas, we get closer and closer to the announcement of a double weekly payment in the run to Christmas for weekly social welfare recipients. Again, something the government is absolutely entitled to do, but given that it happens so regularly, it should be included in the figures and will lead to additional overruns for 2024 because it hasn't been in any figures produced to date. Other departments are also experiencing overruns, like the Department of Children and the Department of Education. But they're exceeding their profile allocations for 2024. And over the last number of weeks, there's been various announcements by the government of a continuation of various cost of living package measures, with many of those to happen in 2024. So even though we've seen an increase in government spending beyond its own stated rule for 2024 and the plans. It looks like, given what's happened, the excess will be even larger as we get closer to the end of the year. Now, at a headline level, looking at the government balance and government debt, that might not appear to be such a huge issue, because corporation tax could plug the gap. Not only we've seen spending rising, one tax head that has shown very significant growth in recent years has been corporation tax. And we now find ourselves in a position of running surpluses, but a large part of those surpluses are driven by corporation tax. You can see the pink Department of Finance estimates of the windfall corporation tax, and with the green being revenue excluding those windfalls, the black being government spending. We see government spending is well above government revenue if you strip out Department of Finance's own estimates of what it believes to be windfall corporation tax, those which could potentially be temporary in nature, or at the very least highly volatile. So while the overall balance might look reasonably sound, once you strip out windfall corporation taxes, there's a deficit running. And if you look at the estimate of the windfalls, what the government intends to do with the windfall, well, they've said they're going to put the windfall into two funds: the Future Ireland Fund and the Infrastructure, Climate and Nature Fund. But if you look at the planned contributions, which come to 6 billion, and look at their own estimate of the windfall, their own estimate is 11.5. Put 6 billion into the funds, that still means 5.5 billion are in sort of day-to-day or general budgetary arithmetic and available to spend. What we said about the corporation tax remains incredibly risky, it's volatile and concentrated. And if you look at recent years and look at sort of the top 10, the top 3, and the most complete figures we have are for 2022. So the green is the top 3, the grey is the top 10, and then we go over on. Even if these were percentages, these figures we start like the top 3 were 10%. That in of itself would be quite startling. But for 2022, estimates in the council are the top 3 were 10 billion, or over 40% of total corporation tax receipts. So we're saying they're elevated, and just 3 companies are responsible for over 40%. The top 10 are responsible for close to 60%. So this is a very narrow, highly concentrated tax base, and it's very volatile. Okay, up to now we've only seen a volatility in one direction. It's been growing up, from 8 to 15 to 23 to 24, and with the exchequer receipts for September due tomorrow, it's potential we'll see even further increases. But this is just highlighting the concentrated and volatile nature of the corporation tax receipts, which are potentially plugging some of the gaps, at least for now, in this higher level of spending we're seeing. And links to the corporation tax, of course, these are large firms, and many of them attract high pay and also high income tax jobs. So they're linked to significant amounts of corporation tax, and also linked to significant amounts of income tax. So there was to be some firm-specific effects that affected just a small number of companies. This green bar here, an estimate of 10 billion, is just 3 companies, all being significant employers, contributing to the level of employment in the economy, and all being a lot of them being high pay, high tax jobs, contributing to income tax and other revenue. And if there was even to be some firm-specific factors, they could have significant consequences for the public finances. But even in terms of economic downturn, just changes in a small number of firms. So there are vulnerabilities there coming from the corporation tax and their employment. So if you look at kind of stripping out some of these factors, so we just strip out 2 factors here and look at where the positive position for the public finances might be if we were to strip out some of these factors. One thing we strip out is the current level of economic activity, a record high employment rate. There's unemployment rate of close to 4%. If we go back towards more normal, not even a significant jump, but back up towards 5.5% unemployment, and the level of economic activity associated with that, and also strip out these windfall corporation tax receipts, again using the estimates from the Department of Finance to give us sort of an underlying deficit. Like, what would happen if tax revenues were slightly lower due to higher unemployment? What would happen if social welfare spending was slightly higher due to that unemployment? And what would happen if you didn't have these windfall corporate tax receipts? And look at where we are for 2023, 2024, compared to plan would put us in 2025. So just making two modest changes, one for the strong level of economic activity, and two for the windfall corporation tax receipts, have a deficit, one that's opening pretty rapidly, from 2 billion in 2023 to 10 billion in 2025. And that is where the government spending in excess of the 5% spending rule, its own 5% spending rule, is coming through. So to put this in context, for that 10 billion in 2025, a deficit this large would require 3,600 of tax increases for every worker, or 1,800 euro in spending cuts for every person. So like, just put it at the level of the individual or the household. So I suppose the deficit in full mightn't be necessary. You wouldn't have to do it in 1 year. It just gives us sort of a sense of scale of the potential underlying deficits the government is running. 1,800 euro for every person, just by having this elevated level of economic activity, strip that out, and the windfall corporation tax receipts. So why is the Fiscal Council concerned? Well, we feel that the risks are pretty clear. The government has few constraints other than its own national spending rule. This commitment made in 2021 to have a medium-term spending path of 5%. And the government faces the constraints of the economy's capacity to take the extra pressure. There's no slack in the labour force. You keep adding to it, and you keep adding to those pressures. So continuing to breach the rule, its own rule, will push up prices and generate a wider underlying deficit. As spending potentially catches up and eats in more of those windfall corporation tax receipts, and maybe the elevated level of economic activity, the gap between that and the sort of more normal level increases. So everyone pays when prices are pushed higher. We wouldn't see a direct link between government spending and prices, but over recent years when people have seen prices rising, they've seen the impact it's having on them. And the deficit could materialise suddenly. Not necessarily a downturn in the economy, but just a handful of multinationals being affected could impact the public finances, whether it's the employment within those small number of firms or the large amount of tax that they are paying. So then just look at some key questions that emerge from all of that. So first, is breaking the rule necessary with high inflation and fast population growth rates? So perhaps when the 5% medium-term path for government spending was set, the level of inflation or perhaps population growth rate wasn't factored in. On the population growth rate, the recent rapid figure we've seen from the CSO, it's still too early to say how much of the population increase will lead to permanent impacts on the economy. So you could be chasing population growth, and that mightn't necessarily be permanent, whether it's linked to those fleeing war in Ukraine, the population growth linked to asylum seekers and refugees, etc. Like, are those changes permanent? And should you be following them with permanent and structural increases in government spending? But whatever the case, in responding to additional pressures now, putting more demand into the economy, the government is still adding to those same pressures, whether it's those price pressures or those labour market pressures. Maybe additional space is needed. And argument could be that in headline terms, the government is running a surplus. In headline terms, we're also running a surplus up to 2008, and we saw the consequences of inappropriate fiscal policy. Here is a reasonable surplus in 2006, but perhaps in advance of the general election for 2007, rather than maintaining or even expanding that surplus in 2007, it was eliminated. And then when the vulnerabilities of the economy are exposed, the temporary nature of the stamp duty and other taxes that the government was collecting from the property bubble, we see a huge deficit emerging in a very short period of time. So there was surpluses prior to 2008. They weren't maintained sufficiently large to be able to absorb the shock that the economy faced. And similarly, even with the huge sums of corporation tax that are flooding in, we're not running huge surpluses, perhaps to match. And even with the scale of them, depending on the size of the gap that opens, you could see a deficit emerging. So the surpluses up to 2007 didn't make things safe then, doesn't necessarily now. And the exposure to windfalls, potentially temporary tax revenues, and the narrowing of the tax base 3 companies paying 10 billion in corporation tax. And some parallels what we saw in the run up to 2008. With more breaches of the spending rule lead to overheating. This is about sort of a long-term view, keeping people's jobs, keeping their real incomes and their livelihoods safe. So we all want more and better service and infrastructure. Well, there's clear demand out there for in terms of housing, health, etc. But the everything, everywhere, all at once approach is costly. There isn't the space in the economy to accommodate that additional demand. So it adds to pressure now, and may mean the government has to later reverse commitments if some of these vulnerabilities are exposed, and we've used all these windfalls, or with increased government spending at a time of very strong economic performance, and those vulnerabilities could be exposed. Things we've seen in Ireland over our history going back 2008, going back to the early 1980s, even going back to the 1950s, could re-emerge again. But what about these deficits? So the council knows and recognises that there are infrastructure deficits, but it's not clear that more money or more funding will help. Like, where is the space in the economy to meet the additional demand that additional spending will bring? So one option is to rebalance to less worker-intensive areas, to cut back in certain areas, and try maybe to increase output in less worker-intensive areas. And we also need better planning, better regulations, and better incentives. So these can promote certainty and greater private sector investment. But again, the private sector faces some of the same real capacity constraints that the government sector does. But the solution isn't necessarily money, or the thing we're short of isn't necessarily money, but the economy itself has a capacity to absorb that, the additional price pressures, and just make it more expensive to do what we want to do. Or should we prioritise? If housing, health, from a government perspective, are priorities, how do we make space in the economy to accommodate those? So that's where we stand with our pre-budget statement prior to the forthcoming budget. Here are the current composition of the council and how our overall mandate operates. So thanks very much for that.